Taher Badshah joins us now. Let's connect with him to understand what he makes of the market setup. Taher, good morning. Thank you for joining us. Taher, summarize the year gone by for us and looking at the trends where we are in terms of macros and valuations. What is in store for 2023?
So, Nikunj, that is what has been the debate in our minds and for the last couple of weeks, and we've been trying to kind of look into as to what 2023 could look like. We at the end of 21, we at least were relatively more clear, and we had a handle that uh, probably looking at the scenario unfolding in terms of interest rates going up in the system as a whole and monetary, conditions winding down or tightening. Basically, it at least gave us the confidence that India would probably be relatively better place. So domestic Indian stories would probably be able to do a lot better compared to, let's say, some of the global stories in the global sectors. And the other thing that we could probably foresee was that commodity prices would kind of level off a little bit during the course of the year. So we could basically try and construct our portfolios around these couple of themes. As we stand today, that has played out quite well during the course of 2022. And as we're looking into what probably holds in store for 23, I'm sorry to say, but we're basically finding it reasonably confusing at this stage in terms of what directions the market can take. And there are several possibilities which come to mind. So, whether it's going to be a global versus domestic play, whether it is going to be a narrow market versus a broad market, whether it is going to be rural India making a comeback. We have most likely seen the urban stories and the urban sectors do relatively well, especially urban discretionary. So there are several of these things where the commodity gainers and commodity prices would continue to kind of uh, wind down a little further, giving a fillip to some of the companies which have lost out on gross margins. So these are several of these things which are probably likely to pan out more particularly in the early part of 2023. And last but not the least, of course, what's going to happen in terms of global monetary policy, especially in the first half of the year. So there are quite a number of open questions which are not fully answered at this stage, and therefore we don't really have a choice but to kind of uh, uh, take an approach where portfolios are reasonably well rounded in order to capture most of these or many of these possibilities which might emerge during the course of 23.
Okay. Uh, where do you see the market despite the macro confusion on interest rates, whether it is recession or slowdown, whether it is interest rate hike or inflation, when these macros are at play, where do you think in this market there is value? And where do you think in this market one should forget value? One has to simply bet on compounding.
Yes, I think so. You're right. The value pockets gradually got exhausted during the second half of 23. So I really can't put a finger onto any particular sector which looks like extreme value to me. Maybe to some extent, IT is probably getting there, or some of the global sectors are getting there, and probably we will see that take hold during the course of the first quarter, or maybe up in the first half of calendar year 23. Um, but otherwise, I think you're right in saying that it is more about compounding, and from here we know that multiples beyond a particular point will find it hard to expand, especially keeping the overall monetary conditions in mind. And you don't really have a choice but to look at companies which will probably have those drivers in order to lift earnings growth, whether it is coming out of margin expansion or whether it is coming out of capacity expansion or operating leverage. So I think focus is clearly going to be back on earnings growth and earnings compounding over the longer term.
Taher, just wondering how convincing is the entire PSU banking uptick story and whether the best may be behind us. Because for those looking to invest right now, the run up has already been quite sharp.
Yes, so on the last evaluation that we did on many of the PSU banks, not just the top tier, but even some of the mid tier public sector banks, and there is the lagged effect of their improving NPA cycle, which still is to unfold in the course, and probably that will happen during the FY24 fiscal. The residual part of that will happen during FY24 fiscal. It's not that it's not been happening, but clearly they are lagged in terms of their NPA improvement cycle compared to some of the other top tier private or probably public sector banks. So I think there is that residual part which is still there, which will basically mean that earnings growth for them and book value compounding will probably be a lot better compared to some of the other banks. But of course, the market has to some degree expected that and anticipated that, as you rightly said. And good part of it, I would say, is there in the valuations. We are somewhere a little above midway in their valuation cycle, and you probably have some bit of steam yet to go, and that should hopefully go through during the first half of this year. So I think that part, the cyclical part of PSU banks, is there to play to some extent still in 23. Now, how many of these will probably, from a structural perspective, are looking at a scenario where their asset books are relatively more diversified, more consumer focused, etc. That is not still fully coming about, and to that extent, then the choices within those banks further narrow down, especially if you have to play something for a more durable perspective.
What's your outlook when it comes to, what would present itself as a huge risk when it comes to the FMCG sector? Would it be the overall valuation metric, inflationary concerns? And in light of that, would you have a cautious view here?
So we believe that some of these names in the FMCG sector at least are primed for a gross margin related operating profitability improvement during the course of calendar year 23, fiscal 24. What is, however, not fully clear, and conditions for which are not entirely known, as I described in the beginning, is about demand, whether rural demand will probably hold up much better. It's not been as great. It's not been as good, at least especially in contrast to urban discretionary demand during the last 2 years and even post COVID. So we expect that some of those conditions will gradually materialize during the course of 23 for rural top line growths to be a little stronger than what they have been. But at this stage, that's not the part of the story where we have a complete hold on, and there are divergent indicators around this. But from a profitability perspective, it's going to be a little better. So maybe not just for FMCG. I think that will be a situation that we will see for much of corporate India in FY24, where you will see top lines actually growing somewhat slower than what they grew in FY23, but bottom lines probably growing a little faster than what they grew in FY23. So you're going to have a bit of a reversal in 24 compared to FY23 from an entire corporate sector behavior.
Good morning. So that's the word that's coming in for you as far as the banking pack is what goes, and the earnings trajectory. Can I ask you that in the new year, would you be willing to relook at PSUs? We did see a re-rating this year, right? Whether you were to look at banks, which we've talked about, fertilizers, defense as well, railways. Is this, a space that you will look at, reconsider?
So we have been having a decent footprint out there in several of the subsectors of PSU, that basket that you mentioned. We expect that this story probably gets further strength into the next couple of years, but that will be strongly predicated and dependent upon whether India can start on a strong, fresh investment stroke capex cycle, and that's pretty critical, not just for PSUs as a whole. Yes, maybe it matters a little more for the PSU basket, but for everything else to hold up, because like as I said, I mean, FY23 was a year of solid top line growth helped by base effect, but somewhat slower profitability growth due to compression of margins, and FY24 is going to be a reversal of that. But then if what holds for FY23 is something which is not clear at this stage. Is it that India is going to probably stabilize at a lower level in terms of growth, or what's going to become very important for us to maintain growth rates is to start on a fresh investment cycle for earnings visibility to get stronger for FY25 and beyond. So I think that's crucial, and that would be crucial more so for the PSU pack, because many of the PSU businesses are in sync with the investment cycle or the overall domestic economic cycle.
Okay, that's Invesco's Taher Badshah only on ET now, talking about the outlook for 2023 as well. Thanks a lot for being live with us. It's a theme that we're going to continue with on the show, where we're getting you big market voices, what their plans are for the new year. Will India continue to outperform other emerging markets and, of course, developed markets? A question we've been asking.